This is Josh Schuler with the Market Profile Trading Academy, doing our somewhat regular every other Thursday series, just to look at some type of perspective of markets, using profiling, using auction theory to try to do better at this game. As if you've been around, here's kind of the flow for today. I'm going to kind of go through some concepts, be queuing up some questions as they come. So I don't want to say, hey, what questions do you have right now? Because you don't even know what we're going to cover. But go ahead and as questions come, throw them in the question box. But I'm going to get through some slides, and then I want to look at today, specifically the trade in crude as it relates to our topic. And then we'll just do some open Q&A to kind of land the plane. Typically we go for about an hour, and really I've probably got 25 minutes worth of stuff. And we are recording this. I'll distribute it to everybody at the end, so if you need to pop off, know that you'll get the recording. You can go back and review it whenever you want. And hopefully we'll have some fun, and you walk away with something that you can use tomorrow. Because trading is simple, yet it's hard. And if there's little tool or tidbit or something that we can add to each other in this community, so that we're raising everybody's level of competence, then I think we're doing the right thing. So with that said, the focus of today's conversation had to do with how to use open types and volatility to predict potential daily trading ranges, which, if you don't know anything about markets, that was a lot of trading jargon. So my apology. We'll unpack all of those terms and what they mean, but let's jump in. So here is there we go. Here's the driving idea around some of this, is that businesses, whether it's trading, whether it's a retail business, whether it's a service, whether it's a manufacturing business, whatever endeavor that you're in, you're going to excel when you can see an opportunity and capitalize on it before the opportunity's gone. So by the time the trend is developed, it's too late. I don't know why I thought about this, but I was grabbing some coffee, going from my downtown office to my home office for this webinar, and going to the coffee shop, and somebody's wearing Crocs. And you look at Crocs as a shoe, and you're going, okay, there was a time when Crocs, and in fact, if you tracked Crocs stock, there was a time when Crocs was killing it. And then there are people that came in afterwards and trying to develop different things. Well, if you try to develop a Croc-like shoe now, it's really kind of past. The time to make money in that market was years ago, when there wasn't such a thing as Crocs, and they saw a potential need and they got in it. This is all we're trying to do in markets. This is where the real money is made, and where we have the best probability for success, is that when we can see an opportunity and capitalize it before it's gone, because once the trend is developed, it's too late. Anybody can develop a trend, and you're usually too late in that. It's like the stale green light at a stoplight or a stop light. You don't know how much longer it's going to last, but man, I know when it turns green from red, I do have something I can lean against. So this is a crucial concept. Tied to that around the conversation today is that not only can businesses excel when they can identify the opportunity before it happens, but they can excel when they have reasonable expectations for the risk facing them. So in top of trading, I do work with startups and entrepreneurs, and I do that work primarily because it's a way to continue income while I'm growing my trading income. So I don't have to use my trading account necessarily for my income. So I can just keep growing that. I'm not having to take a draw off of that. So I have to do some other consulting that helps pay my daily bills, and I can just snowball the trading stuff. But when someone goes to start up a company, one of the things that we look at as venture capitalists or as investors is, what's the risk? If I'm going to invest money in this business, what's the risk? How do we know that we're wrong? And what's the burn rate? I mean, I live in northern Colorado. If you ever want to start a business, one of the groups that you'll know about is Rocky Mountain Venture Capital Club. These guys get pitched to from all over the world, literally, And what's fascinating is that they expect a 10x return on their investment. And the reason for that is because 9 out of the 10 businesses that they invest in fail. Similar performance to guys who want to trade. But what's intriguing is the pitches where they have a clear defined risk. Like we know this is how much we're willing to expend to get where we want to get. And we may get there or we may not, but at least we've clearly defined it. Jimmy Dalton, who's kind of he's not the godfather of profiling and auction theory, but he's a guy I think that made it as tangible and understandable to as many people. If you ever go try to read Stottlemyer's stuff, very technical. It's great, vast research, but I think Jimmy kind of was able to translate it in a way a lot of people could digest it. But he says, look, best risk management is good trade location. It's good trade location. If I can on a day have good trade location relative to however much that instrument is going to move, that's the best risk management tool I could possibly make. So that is another concept, and it's all tied to, if this is one of the first webinars of ours you've seen, the idea that we operate under the guise that markets now, the last 10 years, the last 30 years, and the next millennia ahead of us, if markets are still around at that time, operate as continuous auctions. So they're operating on human behavior that has been in play for millennia. And so we think this is a good way to look at markets. It's a good way to try to discern the action. And so you have to be able to think about the market as a live auction, and who are the participants, what are they trying to do, how good of a job are they doing, and then ultimately, what am I willing to risk to participate? And it's hard to know what you're willing to risk if you don't have some idea. I mean, one, you have to know how much you're willing to risk, and then you have to match that up to what is the probability that risk would be taken out. And so with all of these concepts, this idea of predicting the potential range of a day would be significant edge. Because if I'm trying to define risk and I'm trying to see opportunity before it happens, and I'm trying to have good trade location as the best risk management tool, if it was possible that I could predict before the day played out how the range, what the range could look like, what was possible, that would be such an edge. And what's great, and we'll talk about this as we go through, is that this is possible. So you can actually, from the open of the day, begin to predict and have high probability hypotheses of the expected range of the day before the day has played out. Now this is really helpful for a number of reasons. One, it helps me know what size do I want to have. It helps me know whether there's good opportunity on the day or not. I mean, sometimes I don't remember early when I was trading, I'd sit down to the markets every day and just wore me out. So, so some of you guys, some of you are maybe professional traders, some of you are not. Some of you have this dream of being a professional trader. And I tell you what, one of the things that is, it's hard just on your body if you are coming in and you think every day has the same opportunity. Because the reality is they don't. No 2 days, typically, at least on 3 or 4 days, typically have the same range. I mean, they have different opportunities to them. So to sit down and expect you to have the same opportunity, it's just not there. So if there was a way to know, hey, this is a day that I should stay around, or this is a day that I shouldn't stay around, that would be helpful, because you could, just not trade that day. Go do something fun, recharge a little bit. And by looking at open types and volatility, which we'll unpack that, you're able to see that. So this is helping us define risk, it's helping us define opportunity, it's helping us figure out where do we want to play that we can have good risk management such that we can take the opportunity from the market, all within the context of this idea of auction theory. So let's jump in and talk about some of these open types and what we mean by that. And open types is just purely a nomenclature that is used in auction theory, again, popularized and developed by Peter Stottlemeyer, but also Jim Dalton and a bunch of other people have grabbed this concept and run with it and written books and such. So I'm not creating anything new. I'm just trying to make it palatable. But here's what these open types try to discern. They try to say, okay, what type of day was the prior day? There's actually day types, which we'll briefly reference today. We're going to focus more on the open types, but there's day types as well. What was the range of the prior day, and how are we opening in relation to prior session? So what kind of day, what happened yesterday, and what was the opportunity yesterday, and then how are we opening in relation to that? Now, these are important for a number of things. One, there are correlations, tight correlations, predictable, you can go back test them all you want, that tie probabilities between certain day types and certain following day types. One, for example, is that if we have a large 2 standard deviation or 1 standard deviation move beyond 1 standard deviation, 2 standard deviation, 3 standard deviation day, trend day, the day prior, it's very unlikely that the next day, I mean, when I say unlikely, it's probably less than 25% that we're going to have another day with that wide a range. Is it possible? Yes, and that's an important caveat in all this. I hope you understand that when we talk about probabilities are just trying to identify something I can lean against. It's not a foolproof system, and you'll see this when we looked at the example of what I was trading today. It's not a foolproof system, but it is trying to give me something to lean against. If I can lean against something, then I can know where I'm wrong, take the appropriate action, which that's really helpful for traders. But it also helps me identify the opportunity. So, what was the prior day? What was how wide, how narrow was the prior day? And then how is this day opening in relation to the prior session? So ask different people. There are 4 or 5 different open types that they look at. I look at 5 open types. So one is an open drive. So in this open type, we open and we drive in a direction. There's no him-hawing around. There's no testing one way or the other. We just take off. And you've likely seen this behavior where we open, it just seems like somebody fired a gun or a cannon and we move. So that's one open type. Another one is an open rejection reverse. So this is an open where we open, we go to a specific point of reference, and then we reverse back in the other direction across the open. That's a seen behavior. Third one is an open test drive. So this is one where there's some reference that we go and test that may be outside of the prior range or is an overnight high, overnight low, and then we go test that, take it out, and then reverse and drive in the other direction. That's another open type. And then open auction in range and open auction out of range. So an open auction in range is an open auction where we open and we have two-sided trading inside the range of the prior day. Open auction out of range is where we open and have two-sided trading outside of the range of the prior day. Now, some will distinguish another open type, which is an open auction inside of range but outside of value, or open auction inside of range but inside of value. And for our purposes, we'll just focus on open auction inside of range. But these are 5 open types that we see. Now, in terms of what you're most likely to see, you're most often likely to see an open auction in the range or an open auction outside of range. You will see those more than any other type. After that, you're most likely to see an open drive, then an open test drive, and finally an open rejection reverse. So I apologize for not putting these in the probabilistic order, but that is what you often see. So as we look at these examples of these different open types, we'll see that. Okay, so these are the open types that I have. If you want, this is a great exercise, is to have a notebook, and if you're looking at one product, try to discern, okay, what type of open is this? Because what's really good about discerning open type is that there's correlations between open types and the types of days that come after them. For example, an open drive often leads to a trend day. A trend day in terms of range often is more than one standard deviation of whatever the rolling average range is. What I mean by rolling average range, is tied to a couple of different stats that I trade or check. So one of those is average trading range, or ATR. So this is over a specific time period, what is the average range of an instrument? Is it, like right now, average trading range in, I gotta pull this one up here. Average trading range in crude futures is $1.34. And that's based on 20 days of data. And why 20 days is because when we get talking about implied volatility, those ranges change. So what ranges were there in January may not be there in July or August, and so you have to lean against what is the most recent or actionable. It's the market that you're in, not the market that you want to have. Case in point is NASDAQ futures back in January. We were looking at 100 points a day. Last week we had 45 points for the week. The average trading range now in the NASDAQ, I think, is around 35 points for the last 20 days. So that's a different ballpark in terms of opportunity than it was in January. And so, what you expect on a day, I like, in terms of, goals, trading goals each day, I like to get 25% of the range of whatever vehicle that I'm trading. So if that means when it was 100 points in a day, I want to get 25 points. If it was 35 points, well, now, I'm looking at 8, 7, something like that. Obviously not the same opportunity that it was earlier in the year, and I have to be more perfect than I was when the ranges were wider. So understanding and tracking those ranges is important. Another one that you can track is the average initial balance, and what the initial balance is it's the range of the first hour of trade. So if we'll organize data in auction theory, we organize data in terms of half-hour segments. This is how wide is that first hour. Another one that you can track, although I didn't list it here, is the average range of the first 5 minutes. There are studies out there, for the type of trades that I do. I'm not a scalper. I'm more an intraday swing trader, and that's not a stat that really is meaningful to me. But that same thing, you can track. What's that initial 5 minute range for about 20 days. And I'm going to suggest 20 days is a really good window to look at because you're getting the most recent data for whatever the market is, but yet it's wide enough that it's not just looking at yesterday. So it's a pretty good range. Another one is harmonic rotations that you can track. I don't track this. I know some traders that do track this, and this is the up and down movement in an instrument in a day. So how many times does it move up versus how many times does it rotate down? It's the rotations inside. You can actually track those, and those expand and contract. And then also you have exchange limits. That's the how far can this instrument actually move in a given day? If you trade equities, indices, or futures, you often don't see those. We rarely see the limit down days. We actually saw we got to limit in the ES on Brexit, but then we lifted off of it. But if you trade agricultural products, you see them all the time, especially if you're in livestock. You can see a limit down day or a limit up day where they basically we stop. We're done. We can't move anymore, and those are set. So that's another thing to think about and lean against as you're trading. All right, so then let's add this other component, and again, we're going to pull all these together when we look at the examples, but is the idea of volatility. So how wide these ranges are and what these average 20-day ranges that we see, and why is it that an instrument is 100 points wide in January and is now 35 points wide in August, is based on the volatility. And volatility is simply a measurement of the expected movement of the product. It's what the market is expecting based on who knows what. Could be some news out in the to come. It could be some economic idea, earnings, who knows what. It's why the volatility typically increases. If you're looking at stocks, it increases leading into a earnings report. It's because the market's expecting that this thing's going to move more than it would typically, so the options are pricing that in terms of their premium. But that's basically what it's doing. It's computed by looking at the intrinsic or extrinsic premium in options. That gives us this volatility number, and we can use that to predict what the range will look like. So there's actually formulas for this. Here is, for example, a dashboard that I look at every day. Well, wait, if I do that, then you can't see this. I can put in what's the implied volatility of a product, and then it will give me, based on these different cells, what the expected range on the day is. So right now, given the implied volatility in crude, it says that there's an expected range potentially. The options are saying, hey, look, $2.30 is potential range. Now the average trading range is less than that. It's $1.34, and then this was not today's range, but yesterday's range was $1.11. So you can see where we were relative to what was possible. But this is a great tool to use. And what's great about these formulas, so you can use them for one day, or you can use them for a whole week. So I actually use the same number to compute range for an entire week. So up here where it says the number 5, that is how many trading sessions. So this is for one, and it gives you the difference. And that inside of that expected range, you have about a 68% probability, because it's looking at one standard deviation, or one normal distribution, one normal distribution of what is expected. So we most often stay inside that range. About 70% probability we're going to stay inside of that range, whatever it is. You will get larger moves, and that's something else to look at. So open types, trading range stats, and volatility. So let's pull that all together by looking at actual examples. So I'm going to pull up, we're going to look at crude here. So I was stalking me some crude, and I like crude. Looking out here at a longer term chart, I'm really intrigued by the fact that we've moved now 17%. Is this right? 19% in 7 days. Pretty awesome. I was I was long at 39, and we're taking some off at 42. Thought I was a champ, and then basically sat and have been watching this thing just go. And now I'm really excited to sell this thing and get short. So I was looking to get short today. We had rollover. So if you're not familiar with futures products, they have different contracts and expirations. So we rolled from the September to August or October contract today, and I'm looking to trade. So in my pre-market prep, I'm looking at crude. I'm noticing that my bias is bullish on all time frames. We're above the points of control on multiple time frames. However, yesterday we were 16% up in 7 days. So I'm saying, okay, I'm just looking for signs of where this auction might exhaust. So even though all my biases are bullish, I'm still I'm looking for where's the turn because I know the opportunity is in the turn, not to jump on the trend. Obviously, I can get on the trend, but now you're looking at a trend where crude has been in. We're doing 19% in 7 days. So what's the probability that it does another 19% or another 5% relative to it actually pulling back some? In fact, if when I look at the composite profile, if you look at the volume, the composite volume, you can see this is all white. That means that this is the lowest 40% of volume in this whole composite move. All of the big volume is down here at 47. So, you know, as auctions go, if nobody's participating in the auction anymore, am I going to go with that, or am I looking for this thing to exhaust? So I'm looking for crude to exhaust, even though I'm recognizing that at the moment everything is bullish. Okay, so I'm looking for failure. I'm looking for a counter trend trade. So let's be clear that I was looking for a trade counter the trend, which can be dangerous. Sometimes that can be like stepping in front of a Mack truck. So if don't have something you can lean against to determine where your risk is and define your risk, then you're going to be in trouble. So here's where that starts. It starts by looking at the open type and how we open relative to the prior day. So prior day, if we zoom in here, the prior day is here. Yesterday we had weekly EIA inventory reports, and that is always a binary event. It causes the market to move in funky fashion. In fact, if I explode this this profile out, you can see we open, then we're down, we're up, and eventually we open, you know, to the upside. So I'm noticing the type of day. We actually call this type a neutral extreme day. A neutral extreme day is where you trade past the initial balance, or that first hour of trade, which is in this software denoted by this green line, in both directions. And then we close at the extreme of one of them. So we closed here at 47.50, so near the extreme. If we close in the middle, we'd call that a neutral center day. So when you have range extension on both sides, you have other time frame, or basically big money buyers and sellers participating at the same time, and you're trying to figure out who won the day. Well, who won the day was the buyers, because we are at this side, and so I was looking for us to continue to trade higher overnight, which we did. So this is the overnight session in the profile. Fairly balanced, but as we're getting close to open, and what I mean by balance is you can see that this has a fairly decent bell curve shape, so that this is a market there's decent agreement around value. And we're getting ready to open. When we were getting ready to open, it was towards the upside. So closed higher, overnight inventory is not 100% net long, but it's long, and I'm looking at the open. So here are 30-minute bars, 30-minute candles on the open. So this is my initial balance, this green line here. We had I mean, you could say this is one of two different types of open. This was not an open drive, because we didn't just open and just drive in a direction. We actually came down. This is almost like an open rejection reverse. So we reject value area high of overnight. Don't hear me put a lot of stock in value area high of overnight trade, but we do come down. It appears that that's an area that we tested, and then we reverse and we go into a trend day. And a trend day is denoted by one time framing higher, meaning that each subsequent 30-minute session, we either have a higher high or a higher low without having a lower high or lower low. So we one time frame almost the entire session. I mean, there was a pause here, but otherwise we had higher highs, or at least higher lows without a lower low the whole day. Okay, this right there is a widow maker if you try to short this on the open. And guess what? I know that there are guys that did, because they're thinking, oh, well, this thing's been up 20, or 17%, so I need to get short this thing. And if they didn't recognize that, hey, we opened, but we're outside of the prior day's range. This, make sure that I can see this. I'll make it easier. This is the top of the prior day's range. We're outside of that. So what that's telling me is that someone is still interested in being long this market, and I need to pay attention. So unless we can come back into the prior day's range and spend some time down there, we may never come back to the prior day's range. When that happens, then I'm trying to figure out, okay, then what's the potential for us to, where are we going to go? If the prior day, and this is something to write down, if the prior day is a normal day where we have an initial balance that is not very wide, and we don't extend much past it. In fact, I think in the S&P we've had some days like this. Here's a perfect example. Okay, you can see this day we extend past the initial balance in the ES, but not much. We have a pretty balanced profile. This is a nice bell curve. Okay, if the prior day is balanced and we have an open auction inside the prior day, so we have an open auction inside of range here, and how I know it's an open auction inside of range is because we spent 2 30-minute sessions inside of the prior day's range. Then I can predict that the range of the day will be the same as the prior day, give or take 5 or 10%. So, look at the range of the ES here. We went from 2147 to 2158. It's about 11 points of range. Next day, 2154, 2163. Almost 4 points, or almost 10 points. So when the prior day is balanced, if you have an open auction inside of range, then you can predict the range. So that basically said, if I wanted to get short this thing, I think, in B period we made a bottom here, then I can just count, okay, 10 points. If I think that's the bottom, I've got great trade location. I could get long here and say, I think this is the bottom, and then I'd have 10 points. You could capture the whole range of the ES that day. And you knew that before it happened. Or if you had missed that buy move, because that's sometimes it's a hard move to get, and it's late in the day. This was we get up here middle of the day, we get in the F period, and that's where you hit the 10 points. You could say, I'm going to short here because we're at 10 points. We had an open auction inside of range. Prior day was in balance. So now I can lean against this level, and I could say, I'm going to put a stop in, maybe 1.5 points, or if you want to look at ticks, you could do that. And you have great trade location because now you have this whole day below you that is range to capture from. If you had shorted up here, 2163, look, you're going to get to 2157 potentially. I mean, likely not. You're probably going to, come, somewhere, down here, but you're going to pick up, 5 points, 4.5 points in the ES. It's not a bad day. That actually would have been half the range in that day, so it would have been an excellent day. So that's what happens when it's a balanced day and you have an open auction inside of range. Now let's go back to our crude and look at this. It's not an open auction inside of range. So now I can't lean against the range of the prior day to get a prediction. So that's where I start looking at what's the implied volatility say and what's the average trading range. So if the average trading range, per my worksheet here, my homework, says it's $1.34 and the expected range is $2.30, and we're in a trend day, trend days typically will at least test the normal distribution and can be a 2 standard deviation day. So whatever the range is, that's the average trading range has been, I can lean against that, and then I can say, all right, I'm going to watch the behavior around that level. So that was basically what I was doing today. I was looking for a counter trend trade, and I was watching the behavior once we got close to that $1.30 area. And lo and behold, that $1.30 area was right around in here. Right? So I missed this. The bulk of this. I mean, I got an early long and then a quick short, but I was looking for a bigger trade, and that actually came late in the day. I got short here at 49, actually not 49.05, but I shorted 49, and then I peeled them off as we got back to the point of control here. which was a likely area to test. Now we're testing higher, and I think we're going to continue higher overnight. That's for another discussion. But what that did is, because I knew what the open type was and the correlation of the day type, and I know that that day type tends to do certain things with the ranges, it basically said I could set an alert. So I literally did this. My first alert was at 48.80, and I just walked away. And I didn't miss anything, because I know, hey, you know what? Unless it either hits this number or it's going to be later in the day, because if you're going to try to do a counter trend trade on a trend day, you're going to do that. That's a trade later day. And that allowed me to come back and look at it. And I actually had, I was trying to sell 49.15, 49.20. We never got there, so I manually triggered this at the end. But in terms of risk, I was going, you know what? I'm willing to put this trade on. I know we've already covered the range below me, so I could be large in my size and define the risk. And in this case, I was willing to give about 20 cents per contract. That was it. I could put stops right there. And what's cool is I know, hey, if we go past this, then something's really up. It could be a 2 standard deviation, a 3 standard deviation, and that's not likely because we were so late in the day. But I mean, it gave me a lot of confidence to get in that trade. And having confidence in the trade and knowing when to stay in the trade or when the probabilities are in your favor. So that's the thing. I got short that trade because the probabilities were in my favor that we're going to at least get some kind of pullback, likely to a known reference point, like the point of control, given that we had already gone, to the expected range and beyond on the day. Because if you include the overnight, we were up at like, $1.60 something. So we're past that level. Very, very helpful. So that's how you can use open types and implied volatility, because sometimes you can use the open type and you can lean against the range of the prior day, given how it opens. If you can't, then you can use these other vehicles. And again, what it does is it allows you to have an expectation of, man, what could this day have possibly been? If you had bought, and I was, full disclosure, I mean, when I bought, I think I bought 47.96, which we'll all laugh because we see how the day played out, right? But I was a skittish long. I got up to 48.14 and took it off, and then caught this quick short here, and then I was just waiting. But if I had thought through what type of day it was, becoming, this is potentially a trend day, then you could say, oh well, I've got 80 cents left that I could just stay on there. That would have been, in one contract, that would have been $800 a contract to stay in the trade. Now, how do you know that it's going to become a trend day? Well, that's where that stat of the initial balance becomes helpful. Is the narrower the initial balance, that first hour of trade, the less likely it is to contain the range. The wider the initial balance, then the more likely it is to contain the range. And actually, Window Trader does a really cool thing here, where you can see it looks at IB range, and it said, okay, today the current IB range was 59. This is why I actually exited the trade, because the IB range was wider than the average. So if I'm thinking, oh, it's a fairly wide IB, so how much more are we going to extend beyond that? We may get up and then fall back and just rotate and rotate back and forth. And I don't want to, you never go broke taking profit. But if for example the IB range had been 10 ticks or 20 ticks and the average was 56, then that should be a clue of, oh my gosh, like this IB range is like a teacup and I'm about to pour a gallon of water into it. It's likely going to spill over. So that can help you discern, hey, there's potentially a lot of range extension that's going to happen in the direction of wherever the open was. So in this case, given that the open was above the prior day's range, and we actually went and tested the level and reversed, that was likely the trend. Always easy to see in hindsight, harder to see it in real time. But there's the tools. There's lots of nuance and all that kind of stuff. And this is really meant to just start the conversation. But I do want to give the balance of the time. If anybody's got any questions, go ahead and fire them in the question box, and we'll go after those. And if you were trading something today, we can even look at that specific product. It doesn't have to be futures. I mean, I use futures. I love the leverage. I love the liquidity in them. This stuff works in stocks too. So you can use it in multiple products. Yeah. I'm just going to look at a couple other products while I'm waiting to see some questions populate. And let's see where we're at here. This is NASDAQ. NASDAQ very much in the middle of the muddle. And in this profiling product, these are TPOs, but what's great is this actually shows me intensity of volume. So it's not just time at a price, but it's also showing me volume at a price. And this is the high, if it's hot red, that's the highest percentage of volume, highest 30% percentage of volume of whatever range I've selected. The magenta is the next 30%, and the white is the lower 40%. So you can see we're fairly thin above us, and below us. Right in the middle. This level here is the most traded price. All right, got some questions. Fantastic. What are different day types that you look for? So there are, I actually look for, here, you can see all the day types right there. A normal day, normal variation day, trend day, double distribution trend, non-trend, neutral center, and neutral extreme. Real quickly, a normal day is a day where the IB contains most of the range. Either it contains all of the range, or there's just a little bit of excess on one. A normal variation is where it seems like we have half of the range that the IB holds, and then half of the range that is beyond it. A trend day, which we described, a double distribution trend day is where we actually had an example here today in Crude. Is you can see there's an intensity of volume here, and then there's an intensity of volume here. Now they're not quite matched, but this is two distributions in this trend day. If it was just an intensity in one area, that would be just a trend day. But if it's got two, why this is important is tomorrow I'll be watching, in terms of my bias, which distribution do we stay in. If we're in the upper distribution, that's bullish. If we get into this lower distribution, if we get half back on this trend day, that would be a signal of failure in this market. The non-trend day is where you have a tight range, typically ahead of a binary event of some sort. So, in front of a petroleum report, jobs numbers, FOMC, you're inside of those expected ranges. It's pretty tight. You're not really going anywhere. A neutral day is where, like what we had yesterday in Crude with with Crude and FOMC, is that we extend in both directions, and a neutral center or neutral extreme, close on one side, neutral center is in the middle. So those are the day types that I look for. And there are correlations between open types and day types. So it's almost like you can build a flow chart that says, okay, it's this day type, it's this open type. So then, it will tell me, here's the potential of the day, what kind of day it could be, and how would I know? So great question. Hope that helps. The second question was, do I take to consideration the rollover gap in contracts as a place for price to revisit? Yes and no. You know, I like looking at a continuous contract, and you know, for this data provider doesn't have a continuous contract, so you actually have to look at just that specific contract. So I don't really see the gap. You know, I don't have really good data on it. I found that sometimes, you know, we seem to pull back to those reference points, and sometimes we don't. If I had to stand on one side or the other, I would go with the adjusted contract as a better level to lean against. So, for example, this broker or provider has an adjusted contract. So even though it rolled from one to the other, it actually adjusts the prior prices so that you really don't see the gap in the rollover. So it's more of it's seen as an adjusted continuous contract. I've found that that's very helpful. So I'll be leaning against 47, you know, as a level. Which, yeah, for example, old contract close and new contract open, the gap, that, yeah. So what you need is as a data provider or a platform that allows you to adjust for the contract roll and see it. So you can do it one of two ways. You can either just try to isolate a chart of that specific contract, and some data providers, you know, like if you put in CLV6, it's just looking at, you know, the last, you know, however long we've been trading in crude. And, you know, even before rollover, there's volume that's coming into it that's enough that you can lean against for maybe, you know, a week and a half. So, you know, that's why on this profile, looking at some of the composite data, it's still valid, even though I was looking at it before we rolled to October. But yeah, that's good. Any other questions? Any other questions? Just going to keep doing my homework here. Look at X. So by X, do you mean steel? I'm assuming that you're meaning steel. Yeah. All right. So let me. All right, you have to give me some time to get my bearings here. So this chart is it's 180-day, 2-hour, but I have a 1-week profile, and so this is this week's profile in steel. Fairly balanced week. What's cool is you can use some of this stuff when we look at one prior day to the next day. You can do from 1 week to the next. So, you know, auction theory holds in all time frames, but a fairly balanced day, balanced week in steel. And you think we got one more trading session, so what could potentially happen that would alter this picture, this balanced picture? I mean, could we have a sell off? Sure, we could have we could have a sell, we could have a rally. I mean, nobody knows. However, we do have kind of a weak low. You know, we closed on the lows last week. We got some responsive buying this week. We've come back to revisit these lows. I don't know that that's. You can either look at it one of two ways. You can say this is a test. We hold. Next time we test here, most likely not going to hold. That'd be the third test of that level, and then you start looking for reference points lower. In that sense, you know, in terms of prior weeks, looks like we've got a naked point of control at $18 that's not been tested. We have a naked point of control at $16 that's not been tested. What I mean by that is it's the most traded price of that week that has not been checked to see if that's been valid. Most of those, if you go back, we come back and revisit that price. This one kind of close. but you could argue that that's not been tested. But yeah, we got 1, 2 below, we have 1 above, but given this profile being at the lower end of last week's profile, it's likely we're going to continue lower. And then if I look at the composite, I mean, we got to get past 21. There's a composite high volume node here. Next area would be 20. Doesn't really line up to weekly. So I mean, I think that 18 area is a potential for sure. That is steel. Yeah, definitely taking a pause this week after the big move last week. So I mean, look in terms of ranges. I mean, look, last week I think if you pulled stats, you'd say, okay, last week's range was exceptional, and what was relative to the average, what was this week? Probably collapsing a little bit more in line with what is the typical range. So it's digesting this move before it it's balancing maybe for the next leg down. All right. How do you form a bias early on whether a day is going to be a normal variation, normal day, neutral, center, extreme? So the short answer to that question is I look a lot at how wide the IB is relative to the average. So if it's a narrow IB, and yet for example, if it's a narrow IB and yet we're inside the range of the prior day, then I'm looking for either a breakout, a trend to develop, like an early chop and then break out in one direction or the other, or I'm looking for us to stay inside of that range, which would be more of a normal variation. If I see a really wide, I'll give you a more concrete example. I'm sorry. Okay, so for example, IB range for crude is 59 ticks. Okay, tomorrow if the IB is 85, 90 ticks, 100 ticks, that's a really wide IB, almost double relative to the average. That would say to me, I'm going to lean against that's going to be a normal day. And then I'm going to try to pick which, based on how the profile is developing in the day, which do I think has the best likelihood of holding? Is it the top or the bottom? And then that's where I define my risk. That's how you do it. Neutral, center, extreme days, those are usually the result of a binary event. So if non-farm payrolls, FOMC, EIA report, something like that, where you have a shakeout that's going to take place. If you're going to see neutral days, you're most often going to see them tied to some predictable news release. All right, we'll look at NUGT. Yes, 3 times bullish gold. Actually, I haven't looked at this stuff in forever. So just a cursory advance, looks like we have a range that's fairly in line with what we've seen. And after last week, we have a lower low, lower high. We're establishing value lower, so value is overlapping to lower on the week. This is, even though we got this reflective kickback, I think we got to see Nugget get above 164.55. So you could short here, somewhere in here, and then say, hey, I'm wrong above 170, with the idea that this thing is going to roll and test some of these levels next week. That's my quick read on that. All right, we got 5 minutes. Get them in. Get them in. Good questions. Great questions. I hope that this is helpful. I remember when I started thinking about ranges and expected ranges and potential ranges, and I think I remember the first time I read, oh, you can actually predict what the range was. It's like, oh my gosh, you gotta be kidding me. That's stuff that's at the hard right edge, right? I mean, that's where decisions are made. Can you explain a naked point of control? So a naked point of control is a agreed upon price that the auction has not gone back and test. So think of it like, let's use some concrete example. Milk prices. Milk, that's always a question that's asked in the political season. They always, wait, how much is a gallon of milk, to know whether someone's in touch or not. And milk prices fluctuate. And if $1 a gallon, say we could get it for $1 a gallon somewhere. That's, say it was $1 a gallon in a store for 6 months, and then that's the accepted price. And it may have gone up to $1.10. Sometimes it may have been on a sell for 80 cents, but those were like momentary. Most of the time it's at 8 or at $1. That's the point of control. So then say something happens and the price moves to like $1.50, and we never go back to $1. So we had agreed on that price for a long time, but we never go back to it. That point of control is naked. If the auction starts moving away from it, it can be a little bit suspect because we don't know whether that price is valid or not. And if you're looking at any trading instrument, and regardless of what time frame it is, you will find over and over again, if you're watching for it, that 8 times out of 10 we will go back and revisit a point of control, because that's a place where the market can go back, test, and go, okay, yep, that was a good price, let's go, and let's continue in the direction that we wanted to go. So how that can play out is, let's say, here's the point of control on the ES today was at 21.80. So right now, that's a naked point of control. We've not tested that price again. We also have a naked point of control at 21.6950. Now, between the two, because this was a wider day, if you have a more balanced day, these are more important. But this one, very relevant. So tomorrow, if we were to open, like say up here, I would be looking for us to come back and test this. This would, especially if we were closer to this range or inside this range, that would be a level that I would look for us to test, which is great, because then you could say, if the open was an open auction inside of range, I could do an early short, and my target would be 21.80. That would be a clearly defined target. The question was, since price loves to revisit gaps and test, can you define that as a naked POC? So I'm not sure if I understand the question. Do I define a gap as a naked POC? I mean, you just look at gap as structure. Like here's a tangible example. If you look at the cattle market, we've got structure that are reference points. One of them, if you look on this day, you can see this long buying tail. So this is an open drive. We opened outside of the prior day, and we just got 2 ticks, and then boom, roll. And then we have single prints up to here, and then we double prints, and then single prints. Okay, whoever got in B period, if they're still long, they likely have stops here, because if they didn't buy in A, or they weren't long but from before, they have a defined risk spot. So this is a level that they'll defend or not. So that's a great place to look at. So it's not the same as a point of control. And the behavior at a level like this is more like a low volume node. It can come down, hit it, and go in another direction, or just cut straight through it. When you have a naked point of control, the auction will typically slow as it approaches that level. So like tomorrow, if we open close to 85.25 with a fairly balanced overnight, then there's a high likelihood that we could return back into the prior day's range and come spend some time here, and we'll kind of slow and to figure out what we're going to do before whether we go reverse back this way or move down. So that's the deal. All right, it is 4 o'clock. I want to keep to the expectation that we're going to do this for an hour. A couple things. One, hey man, if you want to talk more about this stuff, give us a call. Go to our website, marketprofiletradingacademy.com, and contact us. And we do some workshops and mentorships and stuff like that. But really, I mean, just spend 30 minutes. Let's just have a conversation. I really want to help people succeed in markets. 90% of traders fail. 90%, and people will spend years and years trying to become successful in markets, and they pick up all the bad habits on the way. Also, we have a Slack channel that is free to anybody who would like to be in it. We are increasingly more and more active in it. We had lots of discussion today using that, and these are all traders that are looking at profiling to wrap context around the market, so it cuts some of the noise that's out there, and it's an environment that I'm in a lot, so you can shoot me a direct message, or if you have a question, stuff like that. And then finally, this is totally new, but we are launching a new workshop that is, we're going to run it 4 times a year. There's 3 sessions. We're going to run each session when we can. There's not exactly 12 meetings, but on meetings at the FOMC. It's not a day that I do a lot of activity anyway as a trader, so I can do other stuff with it. And go to our blog and check this out. The deal is basically, give us 3 days and see if we can't vastly accelerate your trading development. I'm of the opinion that traders either need to commit to their development and get there quickly, or quit. You will save yourself hours and years of your life and thousands of dollars either getting to proficiency and competence, or deciding that you're not going to be able to do trading and you need to go do something else. And I'm pretty confident that in 3 sessions, so there's 3 sessions, you can go read about them. You can take them in order, you can take them out of order, but collectively, I think we can get you to clarity on whether or not trading is for you. And I know that we all have dreams of being traders, and that's awesome, but the stats just say you're not likely going to do it. I'd rather save you the hassle. And there are others that are like, I'm just going to keep picking up stuff online and do that for free. I get that. I mean, I was that guy too, and guess what? I burned through tens of thousands of dollars that I didn't make while I was trying to learn, and years of my life where I was, the opportunity cost was huge because I could have been like actively trading, not learning to trade. So that's as pitchy as I get, by the way. But I've been having a lot of conversations this week with people who are trying to trade, and students that we're working with, and the reality is, like, you're going to either commit, and let's fast track this thing, or let's go do something else, because your contribution's huge, and if it's not going to be trading, it's certainly someplace else. Let's get you there. But if it's going to be trading, let's hammer down, let's go after it. You'll be glad that you did. All right, that's it. I hope you all have a fantastic Thursday night. Thanks for sticking around. We'll get the recording out, so if you have further on questions, we'll post on the website. Go check out the workshop. Seriously, it's going to be pretty incredible. And keep talking to us, and keep learning, and keep after this. Especially for those of you who have the love of, that's something I've been thinking about a lot too. Is if you got the love for this game, that's what's going to keep you around. And it'll keep you around when stuff's hard, and until you get to a level of competence. There is a bell curve in trading performance. It can be accelerated, but some of it's just experience. But I hope we opened your eyes to some ideas around the fact that you could look at a day and predict what the potential range is, and say, hey, there's a lot of opportunity this day, or there's not much opportunity at all. Save yourself some hassle, and hopefully get some more money in your pocket. All right, thanks y'all. We will be back in a couple weeks for our next webinar, and see where we go from there.